Hi, this is Kribakaran Rajendran. I'm the founder of the firm Square of Dottin. It's an algo trading firm. So in this session, we'll be talking about a long-term investment strategy where instead of analyzing the fundamentals of the company, instead of analyzing the profit and loss statement or the balance sheets, we'll be coming up with a single rule-based approach completely based on price, using which we can pick the stock and invest in them. So in this long-term investment strategy, it is going to be a one trade per year strategy, which means as per the rules, we are going to pick up just only one stock and invest in it, hold it for a period of 1 year, and then exit it after a year. That's all. So there is no specific stop loss associated with it. We just invest in it and rebalance it after 1 year period. That's all. So that is why we call it one trade per year strategy. So here's the rules of the strategy. So it is tested based on the Nifty 50 basket stocks. And from Nifty 50 stocks, we are going to test two scenarios. One is find out which is the worst performing stock among the Nifty 50 by the end of December each year. And we buy that stock and we will hold it for 1 year and then we are going to exit it. We are going to sell that particular stock. And the next version is find out which is the best performing stock of Nifty 50 by the end of December and then buy that stock, hold it for 1 year, and then exit it again next year. That's all. So these are the two variations of investment scenarios we are going to test. So we will test with the first logic by taking the total Nifty 50 stocks, find out which is the worst performer of Nifty 50 stocks by the end of December, and we will pick that stock and we are going to invest in it. And if we do this from 2008 to till date, we will see what is the overall returns looks like. And also in order to get the correct results and to avoid the inside bias, we have to test it with a list of stocks which are part of Nifty 50 in those years. So if you consider 2008, Unitech, Arcom, all these stocks were part of Nifty 50. So it is essential that you need to test the strategy with the Nifty 50 stocks which are part of these indexes on those specific years. So we did that and we got the correct results. So we'll see those results. So this is how the returns looks like. So if we are buying the worst performer, which means if you are buying the worst performing stock among the Nifty 50 by the end of by the end of December, this is how your returns looks like. So in this first table, you could see Unitech. So in the year 2008, by end of December, we check all the stocks which were the worst performing stocks. Out of all, Unitech tops the list. It has lost almost 91% by the end of 2008 December. So as per our rules, we have to buy the worst performer. So we have to buy this stock at 32 rupees by the end of December. And if you could see, the price after 1 year holding period is 65 rupees. So we would have invested in Jan 1st 2009 and we would have exited by December 31st 2009. So that 1 year period we would be holding it and it has moved up around 102%. So our return on investment is 100% for the year 2008 alone, because Unitech, after crashing 91% in 2008, it moved up 100% in the following year. So we made that much returns. In the following year, in 2009, we have to repeat the same thing. Find out which is the worst performing stock among Nifty 50 in the year 2009. So by 2009 December, Orcom was in the list, which has lost almost minus 24%. So that is the worst performer in Nifty 50. So as per the rule, we buy that Orcom and hold it for 1 year period. So after 1 year, it further went down. It went down to 145 rupees. So we lost 15% in that. So likewise, we repeat this particular exercise year after year. Find out the worst performing stock and invest in them, hold it for 1 year and then exit it. If we do this year after year for the last 12 years from 2008 to 2020, overall it made only 8% returns, which is comparatively much lesser. So by going with the stock by buying the stock which is the worst performer of Nifty 50, this is the overall returns looks like. Just 1 or 2 year has been good, but if you consider, if you sum it up, the overall returns is just 8% for 10 years, which is very very less. Whereas if you check the Nifty returns, it has given almost 170% returns for the last 10 years with an average yearly returns of 14%. So just by buying and holding the Nifty liquid, I mean the Nifty ETF, it would have given around 14% average returns, which is really good compared to buying the worst performing stock strategy. So we could conclude that buying the worst performing stock is not really a good strategy. So we'll see if buying a best performer could beat this Nifty returns. Will just buying and holding the best performing stock for 1 year, will it give more than 14% returns per year? We'll see that. So now we will test the next logic, which is buying the best performing stock of Nifty 50 and holding it for 1 year and then exit it, and repeat this exercise year after year for the last 10 years, and we'll see whether this has given a good returns compared to buying the worst performer. So this is how the returns looks like for buying the best performing stock of Nifty 50. As you could see, the first row is in the year 2008. Hindustan Unilever is the stock which has given the best returns of all Nifty 50. We know 2008 was a financial crisis year and all the stocks were down, but FMCG did well during that year. So Hindustan Unilever came up the list, which has given 17% in that particular year. So that came as a best performing stock. So as per our strategy, we'll be buying this best performing stock of Hindustan Unilever and hold it for 1 year. So we bought it at 250.3, and after 1 year the price was 264, so which has given 5% returns. Again next year in 2009, we will check by the end of 2009 December, we will check which stock has performed well in Nifty 50 list. So Tata Motors, that particular stock has moved up almost 395% in that particular year. So that is the best performing stock as per the rules. So we invest in Tata Motors in 2009, and that particular stock has gained 65%. So we made 65% returns in the year 2009 by investing only in Tata Motors. So likewise, we check which is the best performing stock on Nifty 50 index, and we invest in that particular stock every year. We check that by the end of December and we invest in it and hold it for 1 year and then we exit it. So by doing this for the last 12 years, we could see it has generated 266% returns overall, with the average returns of 22.2% per year average returns, which is much higher than Nifty. In fact, which is much higher than most of the mutual funds returns. So we could conclude that by testing both the buying the worst performer and best performer, the best performing strategy has given a good returns. So we can just go by pick up the stock which has did well in the past 1 year in Nifty 50 stocks, invest in them just blindly by end of December each year. Go and check which stock has did well in Nifty 50 and just buy that stock, hold it for 1 year and then exit it. Repeat this exercise year after year. With that particular rules, we were able to beat Nifty returns for the last 12 years consistently, and it has given an average returns of around 22% returns every year. So we could conclude this specific strategy of just one stock per year of buying the best performing stock of Nifty 50 has really did well over the past 12 years.